January 29th, 2026. Silver is trading at $120 per ounce. Not $30 like it was this time last year. Not $50 where the experts said it would top out. $120, up 274% in 12 months. And while everyone is watching the price climb, almost nobody is asking the right question. Why? Because buried in the policy announcements coming out of Beijing, Moscow, and New Delhi over the past 6 weeks is a shift so fundamental that it will redefine the global monetary system for the next 50 years. The BRICS nations are not just accumulating silver, they are building the first silver-backed reserve standard since the 1870s. And when this becomes fully operational, the Western paper silver market will collapse under the weight of its own fiction. This is not speculation. This is policy, documented policy. China reclassified silver as a strategic material on January 1st, 2026, placing export licensing requirements on 60 to 70% of global refined silver supply. Russia announced in October 2024 that it was adding physical silver to national reserves for the first time since the 1970s. India is preparing to acquire record amounts of silver, more than any year in the 21st century. And the BRICS gold-backed unit currency, launched in October 2025, contains a framework that explicitly allows for silver integration as a settlement asset for bilateral trade. Let me show you exactly what is happening. How the 8-stage reserve currency collapse pattern is now entering its acceleration phase, specifically because of silver. Why the London and New York paper markets are facing a physical delivery crisis they cannot solve. How China's export restrictions are weaponizing the global silver supply chain, and why the window to understand and position for this transition is measured in months, not years. Because what took Britain 30 years to experience from 1914 to 1944, the dollar system will experience in less than 15, and silver is the mechanism that makes it happen faster. Before we go deeper into the BRICS silver strategy, you need to understand something that most people completely miss about reserve currencies. They do not collapse because of economic weakness alone. They collapse because alternatives achieve critical mass. And critical mass is not just about having another currency. It is about having a settlement mechanism that works when the dominant system breaks down. Gold has always been the obvious candidate for this role. It is dense, valuable, recognizable globally, and no government can print it. But gold has a fatal flaw for modern trade settlement. It is too expensive per unit. If Russia wants to sell $500 million worth of oil to India, settling in physical gold means moving approximately 2.6 tons of metal. That is logistically possible, but cumbersome. And when you scale this to the trillions of dollars in annual trade between BRICS nations, gold becomes impractical for anything except the largest transactions or final reserve settlement. Silver solves this problem. At $120 per ounce, silver is roughly 42 times cheaper than gold. This means you can settle the exact same 500 million oil transaction with approximately 136 tons of silver. Still heavy, but far more divisible and practical for mid-sized transactions. And because silver has genuine industrial demand, consuming over 50 to 60% of annual supply in electronics, solar panels, medical devices, and green energy infrastructure, it cannot be fully virtualized into paper derivatives the way fiat currencies can. This dual nature makes silver uniquely suited for what the BRICS nations are attempting. It functions as a monetary metal for trade settlement while simultaneously serving as a strategic industrial input for the technologies that define 21st century economic power. Solar energy, electric vehicles, 5G networks, artificial intelligence data centers all require silver. Controlling silver means controlling the raw materials for the next industrial revolution. And BRICS nations have figured this out while the West is still treating silver as a speculative commodity. The timeline of BRICS silver accumulation is critical because it shows coordination, not accident. In October 2024, at the BRICS summit in Kazan, Russia, Vladimir Putin held up what appeared to be a prototype BRICS banknote. The media focused on the theatrics, but buried in the summit documents was a more important announcement. Russia would begin adding silver to its strategic reserves, the first nation to do so since the 1970s, when the United States sold off nearly half of its silver stockpiles. That announcement was not made in isolation. Between the second half of 2025 and early 2026, emerging market central banks acquired an estimated several hundred million ounces of silver through shadow buying. Not official reserve programs that get announced in press releases, but acquisitions made through third-party entities, sovereign wealth funds, and non-transparent channels. The advantage of this approach is obvious. They avoid headlines, avoid driving up prices prematurely, and quietly build strategic stockpiles while the Western financial media remains fixated on gold. China led this strategy. On January 1st, 2026, the Chinese government implemented a new export control regime on silver. This was not a minor policy tweak. Silver was reclassified from an ordinary commodity to a strategic material, placed in the same category as rare earth elements. From that date forward, silver exports from China require government licenses. Only 44 firms were granted these licenses, and those firms must meet strict criteria. Annual refined output of at least 80 tons, credit lines above 30 million, and scrutiny at the national level for every export transaction. The impact of this policy cannot be overstated. China is the dominant refining hub for global silver. Chinese exports account for an estimated 60 to 70% of refined silver flowing into global markets. Put simply, the fate of the global silver market now rests in the hands of Chinese policymakers. And those policymakers have decided that silver is too important to allow unrestricted export. The official narrative is about strategic reserves and industrial security. The deeper logic is about creating leverage over Western industrial dependency, while building the infrastructure for a BRICS silver settlement system. India followed with its own approach. Following the examples of Russia and China, India has been preparing to purchase record amounts of silver. Not for speculation, but for reserves. Indian officials have made it clear that this is a systemic change in how they view precious metals. For decades, India accumulated gold. Now, silver is being treated as equally strategic. And given India's massive solar energy expansion plans, requiring hundreds of millions of ounces of silver over the next decade for photovoltaic panels, this makes industrial and monetary sense. Brazil, South Africa, and the extended BRICS members, Egypt, Ethiopia, Iran, UAE, are all watching this coordination. And here is where the game theory becomes fascinating. Each nation individually might hesitate to break from the dollar system. The risk of retaliation, isolation, or economic disruption is high. But when the largest nations in the alliance move together, the risk calculation changes. If Russia, China, and India are all building silver reserves and preparing silver-based trade settlement, the smaller members gain protection by joining the system rather than opposing it. This is how reserve currency transitions actually happen. Not through dramatic announcements or sudden collapses, but through quiet coordination, parallel system building, and the gradual shift of real assets away from the legacy system into the new framework. And silver is the asset they have chosen because it is abundant enough to settle trade, but scarce enough to hold value. Now let's talk about what this means for the Western paper silver market. Because the mechanics of how this system breaks are already visible if you know where to look. For decades, the silver market has operated on a fundamental lie. The lie is that paper silver, futures contracts, ETFs, allocated accounts, and physical silver are interchangeable. They are not. Paper silver is a promise, physical silver is a metal. And when a system is built on more promises than metal, the moment people demand delivery, the system fails. The London Bullion Market Association and the COMEX in New York have operated for years with a fractional reserve system. Estimates vary, but market analysts suggest that the ratio of paper silver claims to physical silver available for delivery is somewhere between 50 to 1 and 100 to 1. This means for every ounce of physical silver sitting in a vault, there are 50 to 100 ounces of paper claims against that metal. This works perfectly as long as most participants settle in cash rather than demanding metal. Traders buy futures contracts, speculate on price movements, and roll contracts forward or take cash profits. Only a tiny percentage ever stand for delivery. Historically, this was around 2 to 5% of open interest. The system was designed around this assumption, but that assumption is breaking. In the last delivery cycle, approximately 9% of open interest stood for delivery. That is nearly double the historical norm. Preliminary data for upcoming months suggests this number could reach 12 to 15%. And this is where the mathematics become impossible. If there are 160,000 open silver contracts, each representing 5,000 ounces, that is 800 million ounces of paper claims. If 15% demand delivery, the exchange needs 120 million ounces of physical metal. But registered COMEX inventory, the silver actually available for delivery, sits at approximately 113 million ounces as of late January 2026. The numbers do not work. You cannot deliver 120 million ounces when you only have 113 million. And this assumes that all registered inventory is available, which it is not. Much of it is already spoken for, encumbered by prior delivery obligations, or held by entities that have no intention of selling at current prices. This is the physical squeeze that BRICS silver accumulation is accelerating. When China restricts exports, when Russia adds silver to reserves, when India buys hundreds of millions of ounces for industrial and monetary purposes, they are removing physical supply from the pool available to Western exchanges. And when Western exchanges cannot source physical metal to back their paper contracts, the system reaches what is called a force majeure event. The exchange declares that it cannot fulfill delivery obligations and settles in cash instead. When that happens, confidence in paper silver evaporates instantly. Why would anyone hold a futures contract if they know the exchange will not or cannot deliver metal? The paper price becomes irrelevant. What matters is the price of physical silver you can actually hold. And that price, as we have seen in the arbitrage between London and Shanghai, can be $5 to $10 higher than the paper price. On January 29th, 2026, the Shanghai Gold Exchange is pricing silver at approximately $124 per ounce, while London and New York are trading at $120. That foregap is not noise. It is the market telling you that physical silver in Asia is worth more than paper silver in the West. And arbitrage traders, the most ruthless and efficient actors in finance, are exploiting this gap by buying cheap paper in New York, demanding delivery and shipping the metal to Shanghai to sell at the higher physical price. This arbitrage mechanism is draining Western vaults in real time. Every month, millions of ounces flow east. They do not flow back. And as the vaults drain, the ability of Western exchanges to maintain the illusion of deliverability weakens. The BRICS nations understand this dynamic better than almost anyone, because they lived through the exact same playbook with gold. For decades, Western central banks leased gold into the market, suppressing prices and creating the illusion of abundant supply. But in the 2000s, China and Russia began accumulating physical gold while the West sold paper gold. By the time Western central banks realized what was happening, the East had quietly accumulated thousands of tons. The gold had flowed from West to East, and it never came back. Now the same thing is happening with silver, except faster. Because silver's industrial demand means there is a built-in consumption mechanism that gold lacks. When silver goes into a solar panel or an electronic device, it is effectively removed from the monetary system. It is not coming back. Industrial consumption acts as a one-way valve, draining the available monetary float every single year. And here is where the BRICS strategy becomes truly elegant. By using silver for both trade settlement and industrial inputs, they create a closed loop system. Russia sells oil to China, receives payment in physical silver. China uses that silver in its solar panel manufacturing, batteries, and electronics. India buys manufactured goods from China, pays with silver accumulated from selling agricultural exports. The silver circulates within the BRICS trading bloc, never touching the Western financial system. Over time, this drains the global silver float into BRICS industrial and monetary reserves, leaving the West with paper claims and empty vaults. This is not theory, this is happening right now, and the velocity is accelerating. Let me show you the mechanism through which this transition forces itself onto the Western system, whether the West wants it or not. Because the beauty of the BRICS strategy is that it does not require the West to agree. It simply makes the Western system irrelevant. The BRICS Unit currency, launched on October 31st, 2025, is pegged to 1 gram of gold and backed by a 40% physical gold and 60% BRICS currencies basket. The gold component provides stability, the currency component provides flexibility, but here is what most analysts missed in the initial launch. The framework explicitly allows for the integration of other precious metals, including silver, as supplementary settlement assets for bilateral trade. What does this mean in practice? It means that while the unit itself is gold-backed, the actual settlement of trade between BRICS members can be conducted in silver. Let me give you a concrete example. Russia exports $1 billion worth of natural gas to India. India does not want to pay in dollars because that exposes them to US sanctions risk and SWIFT dependency. India does not want to pay in rubles because the ruble is volatile and not widely accepted outside Russia. India could pay in gold, but moving 20 tons of gold is logistically complex and expensive. So instead, India pays in physical silver. At $120 per ounce, $1 billion equals approximately 272 tons of silver. This is manageable. The silver can be shipped, verified, and held in Russian strategic reserves, or sold into Russian industrial sectors that need it for domestic production. Russia is happy because it received payment in a hard asset that holds value and has industrial utility. India is happy because it avoided dollar exposure and settled trade in a mutually agreed asset. And most importantly, the transaction occurred entirely outside the Western financial system. No SWIFT, no correspondent banks, no dollar clearing, no Western oversight. Now scale this mechanism across the entire BRICS trading bloc. In 2025, intra-BRICS trade exceeded $1.3 trillion. If even 10% of that trade shifts to silver settlement, that is $130 billion annually, equivalent to approximately 354 million ounces of silver at current prices. That is more than 1/3 of total annual global silver production. And remember, this is silver being used for settlement, not speculation. It is being removed from Western markets permanently. The implications are staggering. First, this creates sustained physical demand for silver that is completely independent of Western financial markets. The BRICS nations are not buying futures contracts or ETFs. They're buying physical bars, taking delivery, and holding them in sovereign vaults. This demand is sticky, meaning it does not disappear when prices rise or when sentiment shifts. It is structural demand driven by the need to settle real trade. Second, This demand competes directly with industrial consumption. The same silver being used to settle Russian oil sales is the silver that would otherwise go into Chinese solar panels, Indian electronics, or South African batteries. This creates internal competition within the BRICS bloc for physical supply, which naturally drives prices higher. And as prices rise, the incentive to demand delivery from Western exchanges increases because the arbitrage spread widens. Third, and most importantly, this mechanism exposes the Western paper market as fundamentally unstable. If BRICS nations are settling $130 billion in trade with physical silver, they need to source that silver from somewhere. The only place to source it at scale is from the Western exchanges and vaults. So they buy COMEX futures, stand for delivery, and drain the registered inventory. When the vault's empty, the exchange faces a choice. Either declare force majeure and admit the paper system is fraudulent, or deliver the metal and accept that prices must rise to attract new supply. Both outcomes benefit BRICS. If the exchange declares force majeure, confidence in Western silver markets collapses. Capital flees to physical markets where BRICS has already positioned themselves. If the exchange delivers metal, it empties Western vaults and transfers that metal to Eastern reserves. Either way, the flow of physical silver from west to east accelerates, and the Western paper market loses credibility. This is financial chess played at the highest level. And the West is 3 moves away from checkmate. Now let's talk about supply, because even if the West wakes up to what is happening, the ability to respond is constrained by physical reality. Silver is not something you can simply produce on demand. It is a byproduct of base metal mining, and the supply response to higher prices is measured in years, not months. Approximately 70% of global silver production comes as a byproduct of copper, zinc, and lead mining. This means that silver supply is largely dictated by demand for base metals, not by the price of silver itself. When copper prices are weak, mining companies slow production or shut down mines. Silver production falls even if silver prices are rising. This supply inelasticity is one of the key reasons silver experiences such violent price moves during periods of high demand. The supply simply cannot adjust quickly. Primary silver mines, operations that extract silver as the main product rather than a byproduct, account for only about 20% of global supply. And these mines face significant challenges. Declining ore grades mean more energy and processing are required to extract the same amount of silver. Permitting delays, environmental regulations, and capital constraints make new mine development expensive and time-consuming. From discovery to production, a new silver mine can take 10 to 15 years to bring online. This means that even with silver at $120 per ounce, the supply response will be minimal in the short term. Existing mines can increase output modestly, but there's no flood of new supply coming to market in 2026 or 2027. By the time new mines reach production, the BRICS accumulation will be complete, and the silver will already be locked into Eastern reserves. Recycling is often cited as the solution to supply constraints, but the reality is disappointing. Silver recycling rates from electronics are around 18%. That means 82% of silver used in devices is never recovered. It is too expensive to extract tiny amounts from circuit boards and phones. Solar panels are even worse. They lock silver away for 25 to 30 years, and even when they reach end of life, most get landfilled rather than recycled because the economics do not work. Industrial waste recycling does better, around 50%, but industrial processes are actively trying to reduce silver usage to cut costs, so the volume available for recycling is shrinking. Add it all together, and the math is brutal. Annual mine production is approximately 800 million to 850 million ounces. Recycling adds maybe 150 million to 180 million ounces. Total supply around 1 billion ounces, but annual demand is 1.2 billion ounces. This is the 5th consecutive year of a structural deficit where demand exceeds supply. That missing 200 million ounces per year has been coming from above-ground stockpiles, inventories held by governments, institutions, and private parties. But those stockpiles are not infinite. When BRICS nations accelerate their accumulation, when they demand delivery of physical metal for trade settlement and strategic reserves, they are competing for a finite and shrinking pool of available silver. And this is why the price is at $120 and climbing. The market is slowly realizing that the old assumptions about abundant silver supply were wrong. China's export restrictions make this worse. By requiring licenses and limiting exports to 44 approved firms, China effectively controls the valve on 60 to 70% of global refined silver. If China decides to slow exports to preserve domestic stockpiles or prioritize BRICS trade settlement, the non-Chinese world faces an immediate supply crisis. Western refineries and mints would have to scramble for alternative sources, which are more expensive, slower to develop, or simply do not exist at sufficient scale. This is resource nationalism, and it is one of the most powerful economic weapons a nation can deploy. China is not blocking silver exports entirely, That would trigger immediate retaliation and diplomatic crises. Instead, China is throttling the flow, creating just enough scarcity to drive prices higher and make Western industrial and financial systems uncomfortable without crossing the line into outright economic warfare. It is calibrated pressure, and it is devastatingly effective. The timeline for this pressure to become unbearable for Western markets is shorter than most people realize. If current withdrawal rates from COMEX registered inventory continue, and if BRICS accumulation accelerates as expected, Western exchanges could face delivery failures within 12 to 18 months. That means late 2026 to mid-2027, not decades, not years, months. And when the first delivery failure happens, when an exchange declares force majeure and settles in cash instead of metal, the narrative changes overnight. Suddenly, every silver investor, every industrial user, every hedge fund and pension fund holding silver ETFs will ask the same question. Is my silver real? Can I get delivery if I demand it? And the answer for most of them will be no. This is when panic sets in. Not panic in the sense of irrational fear, but panic in the sense of rational actors recognizing that the system is broken and acting to protect themselves. Industrial users will lock in long-term supply contracts, accepting higher prices to guarantee delivery. Investors will sell paper silver and buy physical, creating a stampede for coins, bars, and allocated storage. And BRICS nations will calmly continue accumulating, knowing that every ounce they take off the market makes the Western system more fragile. Let me show you what the endgame looks like. Because this is not about silver going to infinity or the dollar going to zero overnight. This is about a transition from one monetary system to another, and like all transitions, it will be messy, painful, and leave winners and losers. The most likely scenario is that silver reaches $150 to $200 per ounce within the next 24 months. This is not speculation. This is mathematics based on structural deficits, BRICS accumulation, and industrial demand growth. At $200 per ounce, the total annual silver market is worth about $240 billion. That is large enough to settle a significant portion of BRICS trade, but small enough that Western financial institutions can still participate in the market without being completely priced out. At these prices, several things happen simultaneously. First, the gold to silver ratio compresses from the current 42 to 1 toward the historical average of 15 to 1. This means silver outperforms gold on a percentage basis, which attracts speculative capital and retail investors who cannot afford gold at $5,000 plus per ounce. This inflow further tightens the physical market. Second, Western governments face a choice. Do they establish strategic silver reserves similar to strategic petroleum reserves, competing with industrial users and BRICS nations for physical supply? Or do they accept that silver will be controlled by the East and adjust their industrial policies accordingly, potentially facing higher costs for green energy, electronics, and defense applications? Either choice is painful and expensive. Third, the paper silver market bifurcates. There will be a paper price, whatever the futures exchanges say, and a physical price, what you actually pay to get metal in your hands. The spread between these two prices could reach $20 to $50 per ounce during periods of stress. Investors holding paper will watch their contracts settle in cash at the lower paper price, while those holding physical benefit from the higher real market price. Fourth, mining stocks become the most volatile sector in the market. Silver miners at $200 per ounce will generate cash flows that rival tech companies. Their operating costs are fixed, so every dollar increase in price flows directly to the bottom line. A miner producing 10 million ounces per year at a cost of 15 per ounce will see profit margins expand from 103 to 185 per ounce as prices rise from $120 to $200. That is an 80% increase in margins. Stock prices will reflect this, potentially doubling or tripling from current levels. But volatility cuts both ways. If governments intervene, if exchanges change rules, if a major mine comes online faster than expected, prices could crash 30 to 40% in a matter of weeks before recovering. This is not a market for the faint of heart. This is a market for those who understand the structural forces and have the patience to ride through the chaos. Fifth, and most critically, the dollar's role as the dominant reserve currency accelerates its decline. If BRICS nations successfully use silver for trade settlement, it demonstrates that alternatives to the dollar are not just theoretical, but operational. Other nations, particularly those in the global south, will take notice. Why remain dependent on a dollar system that can freeze your assets, cut you off from SWIFT, and weaponize your reserves when you can settle trade in physical silver or gold with partners who will not sanction you? This is the mechanism through which the 8-stage reserve currency collapse pattern accelerates. The dollar does not collapse because it is weak. It collapses because alternatives become easier, safer, and more attractive. And silver is the bridge asset that makes those alternatives viable for mid-sized transactions that are too small for gold, but too large for fiat currencies. The timeline is everything. We are currently in stage 6 of the 8-stage pattern. Alternatives are gaining critical mass. The petrodollar monopoly has been broken. BRICS nations are building parallel systems. And the network effects are starting to flip. What used to be easier in dollars is becoming easier in alternative assets. Stage 7 is crisis acceleration, triggered by a delivery failure, a geopolitical shock, or a debt crisis that forces the system to choose between printing money or defaulting. That trigger could come from the silver market. If COMEX declares force majeure, it will send a signal to every commodities market that the Western financial system cannot be trusted to deliver physical goods. Confidence will evaporate not just in silver, but in oil, copper, wheat, everything traded on Western exchanges. Stage 8 is replacement. A new system emerges. Not overnight, but over 5 to 10 years. The BRICS Unit becomes the dominant trade settlement mechanism for the global South. Gold and silver form the backbone of reserves. The dollar remains important, but is no longer dominant, falling from 58% of global reserves to perhaps 35 to 40%. We live in a multipolar currency world where no single nation has hegemonic control. This is the real BRICS shock. Not that they are building an alternative, not that they are accumulating silver. The shock is that it is working. The system is already shifting, and the West is reacting defensively rather than strategically. So what does this mean for you? Because understanding the system is important, but positioning yourself within it is what actually matters. If you do not own physical silver, the question is whether you understand the forces that are driving this market and whether you are comfortable with the volatility that comes with being positioned in a strategic asset during a monetary transition. This is not about getting rich quick. This is about being on the right side of a structural shift that will define the next 20 years. If you own paper silver, ETFs, or futures contracts, the question is whether you trust that the system will deliver metal when you demand it. The evidence suggests that it will not, at least not at the prices currently quoted. The move from paper to physical is not just about price, it is about counterparty risk. Paper silver is someone else's promise. Physical silver is an asset no one can devalue, freeze, or confiscate remotely. If you're watching from the sidelines, waiting for confirmation or a pullback, the question is what confirmation looks like. Will it be a COMEX delivery failure? Will it be $200 silver? Will it be a formal BRICS announcement of a silver settlement system? By the time those headlines arrive, the positioning window will have closed. Premiums will be $30 to $50 over spot. Dealers will be out of stock. Delivery times will be measured in months. The pattern from history is clear. The people who preserve and grow wealth during monetary transitions are not the ones who wait for certainty. They are the ones who recognize structural forces early, position conservatively, and hold through volatility. They do not try to time every peak and trough. They understand that being 3 months early is better than being 3 days late. The BRICS Silver Reserve Standard is not a conspiracy. It is not a rumor. It is documented policy visible in export restrictions, reserve announcements, and trade settlement frameworks. The only question is how fast the transition happens and whether Western institutions acknowledge it before the system breaks or after. Because the creature from Jekyll Island is not just the Federal Reserve. It is every paper-based financial system built on the assumption that promises can substitute for reality indefinitely. And silver is the asset that is forcing a reckoning with that assumption. You cannot print silver. You cannot create it in a database. You cannot substitute it with financial engineering. It either exists in a vault or it does not. And right now, it is flowing from west to east at an accelerating rate. The Chinese export restrictions, the Russian reserve accumulation, the Indian industrial demand, the BRICS Unit framework, these are not separate developments. They are coordinated components of a strategy to control the physical silver supply chain and use that control as leverage in the broader de-dollarization effort. And the strategy is working precisely because the West cannot counter it without admitting that the paper markets are fraudulent. What happens in 2026 and 2027 will determine whether this transition is orderly or chaotic. If Western governments establish strategic silver reserves and begin competing for physical supply, prices will rise sharply, but the transition may remain stable. If Western governments ignore the signal, continue to believe in paper markets, and wait for a crisis to force action, the transition will be violent. Exchanges will fail, industries will face input shortages, and the credibility of Western financial institutions will be permanently damaged. The choice is not whether the transition happens. The transition is already underway. The choice is how badly the West wants to be caught unprepared when the music stops. And for those paying attention, the music is getting quieter. The COMEX registered inventory is draining. The Shanghai premium is widening. The export licenses are tightening. The BRICS coordination is strengthening. Every data point is flashing the same signal. The paper game is ending. Physical settlement is beginning. and silver is the battleground where this fight is happening first. This is not the end of the financial system. It is the end of a financial system, the system built on fractional reserves, paper promises, and the assumption that the United States can weaponize the dollar without consequence. That system is dying, and in its place, a system built on physical assets, multilateral trade, and monetary sovereignty is being born. The real BRICS shock is not that they are challenging the dollar. The real shock is that they are doing it with silver, an asset the West abandoned decades ago, an asset most policymakers still view as a commodity rather than money. And by the time the West realizes that silver is both the industrial foundation of the green energy transition and the monetary foundation of the alternative trade system, the metal will already be locked in Eastern vaults. This changes everything. Not tomorrow, not next week, but over the next 24 months. Those who understand the pattern, those who see the coordination, those who recognize that physical assets matter more than paper claims during transitions, they will be positioned, not for a trade, but for a paradigm shift. The BRICS Silver Reserve Standard is real. The timeline is accelerating. And the window to understand what is happening before it becomes obvious is closing. Not closed, but closing. You have been warned. And warning is all that can be offered. What you do with the information is the decision that will define which side of the wealth transfer you find yourself on when this chapter of financial history is written.